Chapter 6 is about service versus merchandising businesses. And I really like this area. This is the area where I've worked. I've served as a controller in this area, a senior financial analyst in the area of retail. So I really like retail. And retail is also something that all of us can relate to. We can relate to it because we all have to go shopping, whether it's for gasoline, whether it's for groceries, whether it's a trip to Walmart. We all know retail. And retail in this chapter is going to be categorized, or we're going to use the terminology for it, of merchandising. So it's going to be called merchandising. So our learning objectives for this PowerPoint are learning about the difference between service business and merchandising businesses. And then we're going to learn a little more about the two types of inventory systems that are used by the merchandising businesses. These will be the perpetual and the periodic systems. And then lastly, how the accounting differs. So this particular PowerPoint, this particular audio of the PowerPoint will cover mainly the difference between businesses and merchandising businesses, and a little discussion about the perpetual versus the periodic inventory system. Okay, the operating cycles for companies, the two types of companies we're going to examine here are service companies and merchandising companies. Some of you are going to say, well, what about manufacturing companies? Well, we're going to be talking only about service companies and merchandising companies in this chapter. Service companies make their money by providing services. You can think about dry cleaners, a CPA firm, a law firm, all these businesses that make money actually by providing services. Merchandising companies, on the other hand, make their money by selling merchandise. And they maximize, or they attempt to maximize, the difference between what they paid for this merchandise and what you, the customer, pays for the merchandise. Within merchandising companies, you really have two types. You have retailers, which sell to you, the public, and then you have the wholesalers. A wholesaler would go in between the retailer and the manufacturer, and their jobs would be trying to find retailers who would be interested in selling the products that the manufacturing plants or the manufacturing firms have produced. There are very few wholesalers now. So what is happening now is we see more and more the relationship between the retailer and the manufacturer, and this relationship developing. Walmart has been particularly effective in doing this. But the important point up here for us to note is that service companies make their money by providing services, whereas merchandising companies, the important thing to them is inventory, buying the right inventory, pricing the inventory, having the inventory at the right locations. They will all have to pay certain operating expenses such as wages, such as interest expense. They will have to pay for their electricity and utilities. They will pay for rent. So there are some standard operating expenses they will all have to pay, but the difference really shows up in retail, in the revenue section. So over here is a service company, and this is a typical balance sheet, and it's just an excerpt for it. Over here is a merchandising company, and the one they're going to show us is Walmart. So a Walmart store. Notice also that we aren't adding all the zeros in our captions here. We are instead saying this is in thousands, this is in millions. When you do this, this is perfectly proper to do it, as long as within these set of financial statements, all the financial statements are at thousands, and all over here for Walmart, we've done everything in millions. Notice the highlighted or the items in red for these companies. For the service company, the asset that they show of importance here is supplies. The using up of supplies in providing the service. Whereas over in Walmart, the important item here in the current assets is inventory. Inventory represents the cost of everything that Walmart has bought, they have available for sale. The income statements also differ. I think I said previously that this is a very major area where there is differences. In the income statement for the service company, we only show service revenue. This is the sum of all the revenue or the earning process for this company for this time period. On the other hand, over with Walmart, we have sales revenue, which is the net sales. We'll talk about what net means in a later PowerPoint. And then we have cost of goods sold. What is cost of goods sold? Cost of goods sold is the cost of those items which are sold. So sales revenue represents the selling price of the items, and cost of goods sold represents the cost of those particular items which were sold. So it's important to note that when we're talking about this, we are matching. We are matching the revenue on particular items to the cost of those particular items. And how do we determine what revenue to put in there? What items we include within the revenue? These are the items that were sold. We have earned it because the merchandise has been delivered or gone out during that time period. There are three accounts that are particularly important to the merchandiser then. In the balance sheet, it's inventory. And then on the income statement, it's going to be the sales revenue and cost of goods sold. Sales revenue, again, is the merchandise, the selling price of all the goods that they did sell. And this is the cost of the goods that they did sell. So we're matching again these items. The other major thing here is inventory. Inventory represents something that has not been sold, but this was the cost. The cost of that inventory is in this account. The difference between sales revenue and cost of goods sold, which I said is very, very important to the merchandiser, is called gross profit. Sometimes you'll see the expression gross margin, and that's when we find something as a percentage. So gross profit is the difference between sales revenue and cost of goods sold. It's sometimes abbreviated, cost of goods sold is sometimes abbreviated CGS. The difference between sales revenue, CGS, is gross profit. The gross margin relates to the percentage of sales revenue that they get to keep as profit. So we will get to that at a later point. This is one of the most important things you have to memorize. This keeps coming back to you in your later accounting classes. Even if you have to take just one more accounting class, I can almost guarantee you that you will have to know this. This is a relationship between inventory and cost of goods sold and goods available. And really what happens here is we're talking about how much available, what is goods available for sale in any given accounting period. This amount is our beginning inventory plus the purchases or the new merchandise that's come in and become available during that accounting period. These two combined is the maximum amount which we could potentially sell in an accounting period. So let's say Walmart starts out the accounting period and they have $4,800 worth of merchandise. If they had $4,800 worth of merchandise and they have purchases or new merchandise coming in of $10,200, then the total amount which they could potentially sell could either come from the old stuff, the beginning inventory, or the new stuff, the merchandise that's just come in. Now, what happens to this merchandise? This $15,000, which is the $4,800 plus $10,200. Well, it's either going to be sold, in which case it shows up on our income statement in cost of goods sold, or it stays with us and becomes then our ending inventory number. This is a cycle. So what's going to happen is in the next accounting period, this ending inventory will be our beginning inventory for that time period. Some of you are very keen on algebra, so you will see from this that we really have two algebraic equations going. We have beginning inventory plus purchases, which is equal to goods available. We also have ending inventory plus cost of goods sold, which is also goods available for sale. Thus, these are 4 separate numbers presented here. If we gave you 3 numbers, you should be able to find the 4th. We'll have some exercises on this concept later, and you'll see it again. So you can see it as an algebraic equation, 2 algebraic equations, or you can think about it logically, as in goods available is whatever you had on hand in the beginning and what you have added to it during the time period. The 2 major accounting methods of handling inventory for these merchandisers are the periodic system and the perpetual system. The periodic system only updates their accounting records at the end of the accounting period. So we wait till the end of the time period, and then we go, as is underlined here, through and the inventory is counted by the employees at the end of the time period. So it's a very inefficient way to run your organization because you really don't know what inventory items you have on hand until at the end of the accounting period, in which time you go through and count it up. Since you had that accounting equation a moment ago on inventory, which told you that goods available is either going to be sold or it's going to be on hand, if you know what is goods available is, and you know what's on hand because it's been physically counted, then you can determine cost of goods sold simply by subtracting. And that's what the periodic inventory system does. It's not used very much today. What is the problem with this system? Well, the merchandiser really doesn't know what inventory items they have on hand until the end of the accounting period. This means they lose sales. This means that they could have moved merchandise from slow-moving locations to fast-moving locations. They could have adjusted and moved their merchandise, ordered more merchandise, known that they needed to stop ordering merchandise. In other words, they could cut their costs, and they could maximize their revenues. They could maximize then their gross profit if they had a perpetual and not a periodic system. And many retailers came to that conclusion and switched over from the periodic system to the perpetual system. So again, periodic systems, you wait till the end of the accounting period and have your employees count up the merchandise, take an inventory, and this is how you determine what your cost of goods sold is. And there again is our equation. The perpetual inventory system is the inventory system that we use today. It's an inventory system where our records are perpetually updated. And when we say perpetually, it's not exactly perpetually, technically not perpetually, but a retailer has an option of when they want to update their records. So this is a scanning system that you see at Walmart. This is a scanning system you see at Dollar General, where every time you go through the checkout lane, the items are scanned, and the scanning of the items updates the inventory records to show that the merchandise is being sold. Now, on the other areas of the company, they also have something similar to this scanning that's going on at the checkout, in which the items are being brought into their inventory and they're being scanned. And if you go into a retailer and you watch the employees unpacking the boxes, you see them scanning, you see them bringing things into inventory. Some of you work in retail, and some of you have first-hand knowledge of what I'm talking about here. So perpetual system often are combined with the barcodes and using optical scanners to update it. I said something about perpetual. I said it's not really perpetual. That's because what's usually happening with the retailers is they're combining all their transactions and they're updating their records. Maybe it's at the end of the day, maybe it's after 4 hours of business, but it isn't being done at the end of the month. It's being done more frequently. So this helps the store be operated more efficiently, again, because we know what's on hand, we know what needs to be ordered. You can think about Black Friday, for example, the Friday after Thanksgiving, which is a very high volume day for retailers. If the retailers knew which items were selling and they knew early, they could order more items, they could restock, they could bring the items in, and they would be available for sale more quickly, because it's not just Black Friday, it's Saturday, it's that Sunday, it's that whole time period which goes on for probably 4 days. So there could be lost sales because they didn't have a perpetual inventory system. This inefficiency and the need to be competitive has driven most companies to use this perpetual inventory system. There are differences in using the perpetual and periodic that affect us in accounting. So that's why we are having this discussion of the two systems. In the periodic inventory system, then, there's no up-to-date records, and you can't estimate shrinkage. What is shrinkage? Well, shrinkage is theft. Shrinkage is items that have just disappeared. We don't know where they are. We said we had an equation that said goods available is either going to be sold or it's going to be in inventory. Well, really, we have another item. We have a thing called shrinkage, because it wasn't sold, but somehow it just disappeared. If you have a perpetual inventory system, you know what your ending inventory should be, and at the end of the accounting period, when you go out and physically take your inventory, you can determine the difference between what's there and what should be there according to your perpetual inventory system. Under the periodic system, you don't really have a shrinkage, because all you're doing is going through and saying, do I have it? If I don't have it, then it's cost of goods sold. So this is one of the differences here. A company with a perpetual inventory system, not only is it more efficient to run their system with a perpetual system, it is also more effective because you can tell if you have an inventory shrinkage problem. Those who don't have this perpetual system, they could have theft happening and not really be aware of it until the very end of their accounting period, when they go back and they look at what their cost of goods sold is. The next PowerPoint is going to cover how we record inventory purchases under the periodic system and under the perpetual system.